Samriddhi, do you think we should wait for another couple of minutes?
Ma'am, we can wait for at least 2 minutes. I have also dropped a message in the group to join the meet.
I don't know why you need to drop a message every time there's a class. I'm sure they know the class timings by now.
Yes, ma'am.
Anyway, we'll wait for a couple of more minutes and then we should get started. Okay, thanks. Okay, Samriddhi, am I audible?
Yes, ma'am.
Okay, so what I was saying was that even though there are only 8 students now, but I think we should get started. And in the last class, if you recall, we were discussing the balance sheet and P&L, and I was taking all of you through the MSL 302 material, which has already been put up on the Teams platform for all of you. So I hope that all of you who have not done the core courses had a chance to go through that material. Ratnesh, did you get a chance?
Yes, ma'am. I have gone through, but I have not gone through completely. Ma'am, I have a question. Why do we add in between this PNL account, and like how frequently we add? Can we add like wherever we want?
I'm sorry, Ratnesh, your voice is fading away. Are you asking how many times we make the P&L account?
No, no. In between we add all the
Add what?
oh, we add and so like all the things about that.
All the expenses? Are you meaning all the expenses?
In both the sides we add in both the sides.
Acha, in the T account, are you asking about the gross profit calculation and from there when we take out all the
Yes,
expenses?
ma'am. Yes, ma'am. Like that.
Okay, so okay, so Ratnesh, the fact is that the P&L account is basically divided into two parts. It is called trading and profit and loss account. Now, the first part where we just take out the COGS or cost of goods sold from the sales, which gives us the gross profit, that is called the trading account. Okay, and then after this, we make the P&L account where we take out all of the admin expenses, selling and distribution expenses from the gross profit. So that is why this division is given in the P&L account. Only that division is there. Otherwise, there are no other divisions. Okay, Ratnesh?
Okay, ma'am. Okay.
But in common parlance, nobody gives the whole name as trading profit and loss account. We just call it profit and loss account. But that first section where we calculated the gross profit and we showed the gross profit separately in the right hand side, that portion is called the trading account. And this is a very common practice in accountancy, and this is what we've been following. Okay, Ratnesh?
Okay, okay. I get it. I got it.
Okay, great. Any other doubts, any other questions, Ratnesh?
No, ma'am. I don't.
Okay, so maybe once you go through the whole material,
Yeah.
and if you're taking down notes or something, you can keep noting down whatever doubts or questions you may have, and then you can carry it to the class. Okay.
Okay, ma'am. Okay.
Okay. And Abhinav, are you here?
Yes, ma'am.
Yeah, Abhinav, is there any reason why the attendance is so poor? I mean, I think we have 80 registrations, but I can only see some 11 students here.
Yes, ma'am.
Is
Ma'am,
it the same
actually,
thing for all class? I'm sorry.
what all my like colleagues are saying, like they don't have prerequisites and all.
Uh, no, but
So
I think we still have 80 registrations. I don't see those 80 students anywhere. I don't even see a fraction. In the final list that we have got from the ERP people,
yes,
there
ma'am.
seem to be
80.
80 registrations, 80. So
Okay.
who are these 80 people?
Ma'am, it happens in almost all of the classes, but at least I think 30 to 40% students attend the class regularly, I think.
Yeah, because for this kind of a course, it is very important that people are there in the class because there are so many new technical things that everybody is learning. Otherwise, you will keep sitting with a doubt. So if Abhinav, if you can pass on this message to whoever is there, because I know recordings and all are available, that is fine. But you have to, once you go through the material, you will have some doubt or something. So it's better to get it cleared in the class.
Yes, ma'am. I'll
Okay?
send on the WhatsApp group, ma'am.
ठीक है ठीक है ठीक है okay so anyone else who has any doubts or any questions? Okay, so today's agenda would be that we will move through the second part of the P&L account, and we would go through some more finer details. Now, don't worry about all of these concepts a lot because for your class, your focus is going to be on startups. And for startups, the balance sheet and P&L is pretty simple because they don't have many years of operations and so on. But for your understanding, it is important that you look at the finer aspects and understand it as well. Okay, so let us go through that material, and then of course we will go through a detailed case study around a startup, and I will take you through different stages of the startup and also show you how they keep creating their P&L and balance sheet. Okay, so if there are no doubts and questions, I'll share my screen. Okay, and we'll go through the material. Samriddhi, is this visible?
Yes, ma'am.
I've increased the font size. Okay, and here this is just a continuation of some of the more finer aspects of the P&L account and the balance sheet. So I will just explain those to you, and of course if you have any doubts, any questions, you can ask me. Now see, this is a detailed P&L for a company called hypothetical company. So here you can see the sales that we have started with, less sales returns. Now this is a term that denotes the sales that have come back to you. Okay, so suppose you made a sale, but the customer said that no, this is not the product I wanted, please take it back, or it could be damaged, so they said no, this is a damaged goods, so I'm sending it back, or it is defective. Okay, so sometimes your sales comes back to you. So whatever sales have been returned to you have to be deducted from the gross sales that you have made. Okay. Then we have the cost of goods sold or COGS, which is basically all the opening stock of your products that you had. To that, if you're a trading company, then you must have purchased some more, so you add that. Now, just like you are purchasing something, you may also find the product defective, or you may also find the product not meeting the specification, so you can also return it. So your net purchases would be whatever gross you've purchased less the returns that you have. Okay. Then less closing stock is what you are left with. So basically this amount gives you all the amount that you have sold. Now this is only purchases are shown for a trading company where you're not actually manufacturing it. But suppose you are a manufacturing company, then in that case, here you will add all the direct labor, all the direct material, all the direct overheads which are being spent in making your product. So for example, if you're a computer hardware manufacturer, then all the material that is required, all the shop floor workers that are assembling your system, all the overheads like equipment, lubricants, etc., would all be added here. Basically, all the cost of manufacturing your product. Okay. So this is called COGS, cost of goods sold. Now, when we remove COGS from sales, we get the gross profit amount. Okay. The company may also have other incomes, say interest that the company is receiving on its investments, or the dividend that it is receiving from some other company whose shares it has bought. So the other incomes will also be added over here. Okay. Then we come to the other head. So this portion, as Ratnesh was asking, this area where you come to the gross profit, this portion is called the trading account. Okay. And below this is called the P&L account. But in common parlance, we call the entire thing as P&L. So from the gross profit, then we take out all the admin expenses. Now, admin expenses can be office rent, office salaries, insurance, stationery and postage, telephone, fax, electricity, conveyance, okay, depreciation that you charge on equipment and furniture, any other miscellaneous office expenses. All of these are admin expenses. Then we also reduce the selling and distribution expenses. Selling and distribution expenses can be advertising, okay, freight or transport charges on the goods that you have sold, showroom expenses, salesman salaries, commissions, okay, bad debts. These bad debts are basically all the debtors, basically the customers that you had sold products to and who have not paid you, who have said that sorry, we have become bankrupt, or they have died, or they have run away, okay, or they become insolvent. So that is also treated as a loss. So that is also shown. Okay. Then we also deduct financial expenses, which are basically the interest that you pay when you've taken a loan or a borrowing. Okay. So that is also taken out. Any bank charges that you have to pay, commission on overdraft or something, that is taken out, and you get profit before tax. Okay. So this becomes a profit before tax after taking out all of these expenses. On this, you pay tax. So typically earlier the provision for taxes for Indian companies was around 35%, but now it has been brought down substantially. It is now around 22.5%. Okay, so you take out the tax, and after this you get net profit after taxes. Okay, this is called your EAT, earnings after taxes, net profit. This is the money that actually belongs to the owners of the company, the shareholders. Okay, so this is one example. Then this is the format that we are following now. It is called the vertical format, where you can see instead of dividing it into two columns, we are giving it one after the other. Okay, so it's the same thing. So this is called the vertical format, and this is called the horizontal format. Earlier, India used to follow the horizontal format, but after 2013, the revised Companies Act, we are following the vertical format. I'll show you the real formats also that we have been following. Okay. Any doubts, any questions, please ask. Now here are the details of each item. What do you understand by sales revenue? What do you understand by cost of goods sold? Okay. In case you have a manufacturing company, then this would be your cost of goods sold. Okay, your direct labor, all other factory manufacturing expenses, everything will be included. Okay, so this is it. Then this is how the P&L account is made. Basically all the calculations that are done. This is it. Okay. Then another thing, adjustment items. Now I told you that the matching principle says that if you're looking at revenues for 1 year, then you should match it with the expenses also for that 1 year. Okay, so for example, salaries are paid at a rate of 4 lakhs per month. Salaries paid are for 10 months. तो मतलब 10 महीने की सैलरी आपने दे दी है, but 2 महीने की सैलरी you still haven't paid. So in the income statement, your salary item will be like this. Salary paid 40, add the payable salary. So total bill will be for 48 lakhs only, because आपका एक साल की salary is 48 lakhs. But yes, you have only paid cash for 40 lakhs and this 8 lakhs is still unpayable. It's still not paid. So it's a liability for you. Okay. Then similarly, if there is insurance, that is supposed to be of 3 lakhs for 1 year and you bought it on 1st of August, then if you are making your P&L on 31st of March, so in that you have already used up 8 months of insurance, but on 31st of March you still have advance payment for 4 months of insurance left with you. So your actual investment bill for that year is only 2 lakhs. Okay, so these kind of adjustments are done to meet the matching principle. Okay. Then I also told you that the conservative principle says that in case you anticipate that the company will make some loss or there would be some bad thing that can happen, you have to make a provision for that. So companies do create a provision for bad and doubtful debtors where they write off some part of the debtors as a loss. Okay, and how do they arrive at this figure? Typically it is seen that around 2 to 5% of your customers to whom you have sold on credit don't pay back. Okay, and what the company does is it looks at its past history, sees how much of credit sales we had made and how many people did not pay up, and based on that it then creates provisions. Okay, and these provisions are audited by the auditor and they also agree, yeah, I think you have calculated it well, so you can show it as a provision for bad and doubtful debts. So this is treated as a loss. Okay, so all incomes and revenues and all expenses and losses find their way to the P&L account. So you can read about all of this also. Fine. This is what I was telling you. Now, whatever your income statements are there, they are used for internal management, they are used for public information, they are given to the board of directors, they are given to the company law officials. Okay, so they serve a lot of stakeholders. Okay, any kind of extraordinary or abnormal loss or profit is also shown, but it is shown as that because it is not occurring from your normal course of business, your normal selling of product or service. It is coming due to some extraordinary situation like a big fire or a major accident, okay, or riots. So all of that is shown separately, abnormal loss and abnormal profit. Okay, now as I showed you, the moment we get the net profit figure, before carrying it to the balance sheet, we make an intermediate account which is called the profit and loss appropriation account. Here we basically appropriate. You understand the English word appropriate? That is to divide. Okay, so we divide the earnings after taxes into the following amounts. The company may create a general reserve in which it puts 30. It may create a debentures redemption fund. That means the company has taken some debentures and it wants to pay that. So it may want to save some money in that reserve. Then it can also have a reserve which is long-term asset replacement reserve. That is, we want to replace a machine, it is becoming old. So I'm putting some money aside so that when I need the money, I can just take it out from this reserve and buy. Then there is another reserve which is called dividend equalization reserve. Companies that pay stable dividends like to maintain this reserve, so and they keep putting some money in that reserve, so that in the years when the earnings fall or their EAT falls, then they can take money from this and pay the dividends. A company can only pay dividends from two sources: from the current year's income or from the dividend equalization reserve. That is it. Nowhere else it can use to pay dividends. Okay. Then they have also proposed a dividend payment of 50, 50 million or lakhs, and the balance that is there, which is going as retained earnings, this could be again in the form of some reserve or surplus, is 50. So this is how it is all divided. And then in this, the dividend that is proposed is given to the shareholders, and the rest of the reserves are carried to the balance sheet, okay, and added towards your shareholders' capital. Any doubts, any questions so far? So if you're not asking me any doubts or
Ma'am,
questions, yes,
can you
Ratnesh.
can you please explain what is dividend? I don't know.
Okay, Ratnesh, what happens is that when the company is formed, the owners are its shareholders. You remember that, Ratnesh?
Yes, ma'am.
Okay. Now, how do the shareholders get paid from the company? There is only one way in which the shareholder gets paid from the company, and that is when the company makes net profit. And
Yes,
in
ma'am.
the profit and loss appropriation account, they decide who decides. Basically, the shareholders only decide that okay, this time we have made 200 lakhs, but the company has some good growth opportunities, so let us take 50 lakhs as dividends, and the other 150 lakhs I think the company should retain it. Okay, so this 50 lakh dividend is basically the share in that net profit which gets divided amongst the shareholders. So what the company does is it writes a check for the dividend amount per share and it sends it to the shareholders. So that money goes out of the
Oh,
company and it goes into the
oh,
account of the shareholders. Okay. So this is
okay, ma'am.
called
Okay.
dividend income from the shareholder for the shareholders. Okay, Ratnesh.
Yes, ma'am. Yes.
Naturally, the
It's
amount that
clear.
is the amount that is retained is only net of the dividends that have already been paid out. So whatever else is left, like we saw in the P&L account, all the reserves that money was going in, all of that gets retained into the company and gets added on the balance sheet. Okay, Ratnesh. Now the
Yes, ma'am.
shareholders may also decide that listen, we don't want to give anything to the company. The company does not have any growth opportunities. We want our money back. So they might say that okay, we are voting on a 100% dividend payout. That means in 200 lakhs, all the 200 lakhs will be paid out as dividends. So the company will then write a check for 200 lakhs to all the shareholders and send it to their account, and zero will be taken to the balance sheet. Okay, Ratnesh?
Yes, ma'am. Then after that, what will happen to company? Like it is just a legal entity, and
The
after
company will
what will
get
happen to
nothing.
company?
So basically what will
How?
happen is that company is not getting any extra money. The company already has assets, the company already has capital invested. It is just that from this year's profit, the company will not get any money. Everything will be shared amongst the shareholders as dividends.
No, ma'am. But shareholders, if shareholders had taken 100%, then who will be the
No,
owner of the
Ratnesh,
country after that? Like,
they have only taken 100% from that year's net profit. They have not taken away their entire capital.
okay, okay, ma'am.
I'm just saying that in this net profit from this year's profit and loss account that the company has made, the shareholders have decided that let us distribute all of the net profit and have dividends only. Let us not retain anything in the business. So in that case, the company will not die because the company is already having the share capital from the past years. The company is already having assets. Company will continue.
Okay, ma'am. Okay.
Okay, is that
Okay.
clear?
Yes, ma'am. Yes.
Okay, so this is the only way in which a company directly gives money to the shareholders, the only way. The other way in which shareholders can make money is by what is called capital gains, that is by trading in the shares of the company in the secondary market. So suppose you're a shareholder and I'm a shareholder, then instead of dealing with the company directly, in the secondary market, we trade with each other on the company's shares. So suppose I bought a share at 100 rupees and then the price of the share goes up and I sell it at 115. So I make a 15% return. So these are all called trading transactions or secondary market transactions or capital gains transactions. Okay, here the company is directly not giving any money. You are trading with other shareholders in the open market. Okay, Ratnesh. So these are the two ways in which a shareholder can make money from investing in shares. Anyone else? Any
Okay,
other
ma'am.
doubts? Thanks, Ratnesh. Any other doubts? Any other questions? Okay, so I'm coming back to the material. So this is the example of the P&L appropriation account. Okay, and this is the description of that. All of you know that all the reserves that are created are going back to the company, and the company can use this money to make more assets, to expand its operations, to make more products and services, to sell it and make more money for the shareholders. So the main objective of the company is to maximize the wealth of its shareholders. Okay, then we have come to the balance sheet. This is how a typical balance sheet would look like. So this is how we used to make it in India before 2013. This is called the horizontal form of balance sheet, in which India used to show liabilities on the left side and assets on the right hand side. Now we follow what is called the vertical format. I'll show you the format in which we have liabilities first and then assets below it. In the US, we have the reverse. We have assets first and then we have liabilities below it. Okay. So let us look at the liability side. Typical items here would be the share capital, that is all your equity shareholders, then your preference shareholders, then all the reserves and surplus that you have created through the years. So you may have a share premium reserve, you have general reserve, dividend equalization reserve, long-term machinery replacement reserve, loan redemption fund, P&L appropriation, general reserve. Okay, then you have secured loans of 11% debentures. Secured matlab they have some asset that is there as collateral. Then you have unsecured loans which are also 13% long-term loan, but here they have no asset as a collateral. Okay, so this is riskier and that is why the interest that is charged is higher than the secured loans. Then you have current liabilities and provisions, as I told you. You have sundry creditors, bills payable, dividends payable, provision for taxes. Okay, all of that come over here. And on the asset side, you have long-term assets or fixed assets. So you have plant and machinery. You take out the depreciation from there. You have net plant and machinery. You have other office equipment and furniture. You take out the depreciation from there. You have net office equipment. Okay. You have other investments of 110 lakhs. Then you have current assets, cash, a bank balance, marketable securities, inventory, your stock, then your debtors, bills, receivables. Okay. All of these are given in your asset side. You will always find that the balance sheet totals will always tally. Okay. This is the vertical format in which basically we are just giving the liabilities and then below that we are giving the assets. Okay, so here you can see liabilities are all your sources of funds and assets are all your application of funds or resources. Okay, so it's the same thing given in a different format. Okay. Do all of you understand what depreciation is? Can someone tell me what do you understand by depreciation? Alia, do you want to take a guess? Alia Khan, are you here? Aniket, do you want to answer?
Hello, ma'am.
Yes, Aniket.
Hello. Yeah.
Yes,
Depreciation
Aniket, I
means
can hear you.
Hello. Decreasing of value over the time. Decreasing of value of assets which company holds, and so we can subtract that value from our profit and loss also to pay less tax.
Very good. Very good, Aniket. Very good. You're bang on. Basically, depreciation is a facility that is given by the Income Tax Act of 1961. In fact, it is given by income tax authorities across the world, in which they allow the company to write off a certain part of the value of that asset every year, okay, and treat that writing off as a tax deductible expenditure. Now, suppose a company has bought a machine worth a crore, okay, then every year the Income Tax Act allows the company to write off some part of that value of the machine and treat it as a tax deductible expenditure. So basically, in depreciation, the company is not actually giving that money to anyone. The company has already bought that machine. But in the books, in the P&L, we show it as an expense so that our tax liability goes down and we end up paying lower taxes. Okay. Why is it done? It is done to encourage companies to buy more assets, buy more machines, modernize their equipment, okay, and take this as an advantage. Otherwise, companies would have felt that, I bought one asset, now let me buy it after many years because it is such a huge expenditure. So companies keep saving tax by charging depreciation, and the government wants that all the taxes that they have saved, that they should use to modernize their assets. Okay, so it is given as an incentive. Similarly, the interest that you pay on loans is also allowed by the income tax authorities to be charged as a tax deductible expenditure. Otherwise, if you see, interest is just a financing expenditure, it is not an operating expenditure. You're not spending interest to make your product or service. It is not an office expense. It is not a selling and distribution expense. It is a financing expense. You have taken a loan. That is why you're paying interest. So income tax authorities across the world allow companies to treat the interest paid also as a tax deductible expenditure to reduce their tax liability. Why do they do that? They do that to encourage companies to take more loans. They do that to encourage their banks, financial systems, other financial institutions. Basically, they want the financial system to work very well, more loans being given, companies taking more loans so that, the economy can grow, people's savings can get invested, and so on. Okay, so all of these, both depreciation and interest, are given as tax deductible expenses so that companies get encouraged to replace machinery. Yes, Aniket.
Ma'am, I wanted to ask one doubt.
Yes.
When company deduct the value of their assets from their account over the period, that asset becomes free of value. This
No, so Aniket,
value,
yes. So actually, Aniket, there are two ways to calculate depreciation. One is what is called the straight line method. In straight line method, it is very simple. Suppose the asset is of 1 crore and it has a life of 10 years, then every year you just divide that value by 10 and every year you write off 10 lakhs. So at the end of the 10th year, the balance sheet value should be zero, as you have rightly said. Okay. But in real life, we don't follow that method. We follow the method called written down value. Okay, written down value method. This is what is followed in real life, in which the income tax authorities assign a percentage for every asset class. So for example, for cars, it is 25%, for computers, it is 60%. This is the rate of depreciation. And what you do is that today, suppose I bought a car, the company has bought a car for 10 lakhs, and the rate of depreciation is 25%. So I will take out 2.5 lakhs, okay, for this year's depreciation, and the next year's opening balance for that car will be 7.5 lakhs. Now I will charge 25% on the 7.5 lakhs and reduce that for the next year. So as a result, the value becomes very small, but it never becomes zero. Okay. The other thing is, what the income tax people do is, instead of charging depreciation for each car separately, they put all of the assets that have the same depreciation rate into one block. Now you can imagine, for a large company, a block may have hundreds of machines or vehicles. Okay, so and they keep adding more machines, and they keep selling off the ones that have become obsolete, or putting it away for scrap value. So the block always continues to exist, and so you will never find zero value. You will find that very rarely in a company. Okay, Aniket, so that is how in real life we manage depreciation. Okay.
Uh, Ma'am, once the value of any asset, let's take a machine which is of course 1 lakh rupees, and over the period its value becomes 30-40,000 in account. But if company sells that machine to someone else uh,
Hmm.
on for more price than that actual price shown in the account, then what happens?
Huh.
How it is included in
Okay.
account?
Okay, very good question. So Aniket, suppose the written down value of the machine in the books of the account is 30,000, as you said, but the company wants to sell it now because the company wants to buy a new machine. So company is selling this old machine, and the company is able to sell it at say 50,000. Okay, so this 20,000 that the company makes on the sale is the capital gains that the company has made, and on this capital gains tax is levied. Okay, Aniket.
Okay, ma'am.
And similarly, suppose the written down value is 30,000 and the company is able to sell it only at 10,000. So the company makes a loss of 20,000. Now this is called capital gains loss, and the company is allowed to recover this capital gains loss from any capital gains that come to it over the next 8 years. Okay, Aniket, this is the policy.
Okay, ma'am.
Okay. So I'm just giving you the latest what is happening in income tax practices so that you know. But for startups, you will not have, because a startup, let alone selling an asset, they would first not have any machines. They would spend the first few years just building up their machines, and also their P&L and balance sheets are much simpler than that of a large established company. But I'm giving you the entire aspect so that once you understand the bigger picture, then understanding a smaller part of it will be so much easier. Okay, Aniket? Okay, fine. So now we go back to the material. All of you know tangible assets are things that you can touch, feel, and see. Intangible assets are like your IPR, patents, trademarks, and all. And when you write off tangible assets, it's called depreciation. When you write off intangible assets, it's called amortization. Okay, investments, all of you know. Current assets, all of you know. Basically, cash is converted into raw material, then it is converted into work in progress inventory, then it is converted into finished goods. Then if we sell these finished goods on credit, then we create sundry debtors and bills receivables. Finally, when we collect it from them, we have more cash, and this denotes the entire operating cycle. It is also called cash conversion cycle because we are basically converting cash back to cash, and it is also called C to C, that is cash to cash cycle, or 3C, cash conversion cycle. Okay. Then these are all your current assets, their description. These are the other assets, current assets that can be there. Okay, then this is a description of all your liabilities. What is share capital? This is just for your understanding. Okay, what are reserves and surpluses. All of these are there. You don't have to worry about this for startups because startups will not have much of earnings. Forget reserves and surplus. They are always living hand to mouth. Okay. These are secured loans with some mortgage, unsecured loans with no mortgage, current liabilities which have to be paid off within one accounting period. Okay. So all of this is there. Then this is a summary of the key points. So when you read, this will just summarize all the key points for your information. Okay, so that you have all of the equations and all with you in one place. Okay, this is continuing. Then any doubts, any questions that are coming to your minds, please ask. You can try these objective type questions also at the end, just to check your knowledge whether you've understood this. You can try these fill in the blanks also. Please understand, students, that this is an extra material which I have given you so that you get a background, especially when you have not done the core courses, okay, or finance before this. This will not be a part of your exams. In your exams, we will only be focusing on startups, okay, and the financial management for the startup. So I'll tell you the material that you should focus on for your exams, but for your knowledge, this is very good and very good material and information. Okay. So again, all the answers are given so you can check it. Please don't cheat. First try and solve it. Even if you're wrong, it doesn't matter. After that, only check. Okay. So this is there. Now,
Excuse me, ma'am.
yes, who's this?
Alia this side. Good afternoon, ma'am.
Ha, Alia, tell me.
Ma'am, I had a doubt. Like in startups, we calculate CM1, CM2, CM3. Then how is CM3 is actually the earning that the founders are getting. So how is it different from EAT that we were talking about?
When you say CM, are you referring to contribution margin, Alia?
Yes, yes, ma'am.
Yes, contribution margin is just the selling price minus the variable cost. The EAT, as you have seen, is after this we take out all of the admin expenses, all of the selling distribution, everything else is taken out and then we get EAT. So contribution margin is more of a break-even concept and EAT is more of a accounting concept. Okay, Alia. So contribution
Mhm.
margin is a very small part of the entire accounting spectrum. It is just the
Mhm.
selling price minus the variable cost for making a product. It does not take into account all the other costs that are involved in making a product. But EAT is the complete net profit that comes after you have deducted all the expenses, whether they're variable cost, fixed cost, interest cost, depreciation, everything, taxes, and then you have arrived at the net figure which is available for your shareholders. Okay, Alia.
Okay. Okay, ma'am.
So the
All.
shareholders will only be able to eat the net profit. They will never be able to take the contribution and eat it. Okay, that will not be the
Mhm.
return. Okay, Alia.
Mhm.
So
Okay,
don't
ma'am.
worry. When we do break-even analysis, then we'll do contribution margins again in detail, and then you'll be able to see the difference. Okay.
Okay, ma'am.
Okay, Alia. Thanks. Anyone else who has a doubt or question? Okay, so I'm coming back to the material. Now this appendix has the new format of the balance sheet given as per the revised Companies Act of 2013. This is for you to go through, look at all the details that are given. And below this format, this is given by the Ministry of Corporate Affairs. Okay, and below this format, they have also shared what each item means. So see, they have shared the general instructions for preparation of balance sheet, and they have also written what should be the cycle, what you should involve in each, what you should include in share capital. Everything is given in great detail over here. This is for your information and for your knowledge. Okay, so this is the real format of the balance sheet as per the revised Companies Act of 2013. Everything is given. See, what will you include in short-term borrowings? What will you include in current liabilities? Everything. So this also you can read at your leisure. It is also given on the Companies Act website. You can go to a website called indianlaws.com, or simply you can Google the new format of balance sheet and you will get all of this. Okay. So all these details are also given in this material for you in one place. Okay. So that you can go through it. So all of this is there. Then let us look at what else is there. Inventory में क्या क्या होना चाहिए, ट्रेड रिसीवेबल्स में क्या क्या होना चाहिए, what would cash and cash equivalents include, शॉर्ट टर्म एडवांसेस एंड लोन्स में क्या होगा, ओके, कंटिंजेंट लायबिलिटीज में क्या क्या होएगा. Then this is the new format of profit and loss account. As you can see, it is again in vertical format. Fine. Here they are giving the current year and as well as the previous year's data. So all of this is there. And you have general instructions for preparation of statement of P&L account given under subsection 2 of section 210 of the Act. So all the details are given here. Finance cost में क्या होगा, additional information में क्या क्या होगा. Okay. So this is just for your information. I'm not going to ask you to make any P&L or balance sheet in the new format because that is not in the purview of your, the scope of this course. It is taken from mca.gov.in. MCA is basically Ministry of Corporate Affairs. These are also some illustrations that I have put from very good accounting books for all of you who want to read extra. Okay, so this is there. Any doubts, any questions so far?
Ma'am, I had a question. Like
Yes.
this reduction of tax while loans, is it like everywhere or just like in India or?
No, Ratnesh, you are saying about interest being treated as a tax deductible expenditure.
Yes, ma'am. I was just.
Yes, it is there across the world.
Okay.
Except for
So
in Sharia law, except for in Islamic banking. In Islamic banking, there is no interest. Okay, interest is considered haram, so there is no interest in Islamic banking. But for all other Anglo-Saxon countries, Anglo-Saxon I mean, erstwhile British Commonwealth nations or US and all, we all follow the same. Okay, Ratnesh.
yes, ma'am. Like, but in that case, isn't it like big companies can take more loans and they can grow faster and they can exploit this rule, like, and
Absolutely,
yes.
absolutely. I completely agree with you. I think that's a very keen observation. See, they say money begets money. That means that if you have money already, it becomes easier for you to generate more money. And this is an example of that because larger companies having more resources are able to take more loans because they have enough earnings. They are able to make more assets, they are able to sell more. And that is why the concept of economies of scale becoming a major entry barrier for startups is so true because the new startup is never able to compete at the kind of economies of scale that a large company has. Because when you're operating at those large markets, then you're able to negotiate better prices or costs for your raw material because you're buying in bulk. So when you're buying in bulk, you're buying at wholesale prices. But for a startup, which is a small company, nobody gives you wholesale prices. Everybody will sell you at retail prices. Okay, so naturally, it becomes a very big challenge for a small startup to try and compete with a very large established player already there. And Ratnesh, let me give you an example. When India was opening up its retail sector, remember there was so much of hue and cry from our small sole proprietor ration shops and kirana stores when they were planning to bring Walmart in. Remember? Because they were saying that we can never compete with a large company like Walmart, which is functioning at such huge market sizes that their prices and their cost we will never be able to compete with. and our business will be lost. And that is why there was so much of hue and cry, and finally Walmart had to come through another route. We could not allow, initially we were wanting to allow 100% FDI in retail. You remember, Ratnesh, reading about all this?
No, ma'am, I don't know about that, but
Okay,
okay.
but this is an example where a
Okay.
large company, which is performing at such huge market shares, is able to negotiate such amazing prices and costs for their products, which a new company or a new startup can never do because they're very small. Okay, Ratnesh?
Yes, ma'am. Like, but in WHO, like, there is no rules against this. Like, it is not good for trade. Like, I think,
It is not good for Ratnesh.
like trading, like small countries for a small countries and big country, like US is a US GDP is is much than like India, and in that case, like
Yes,
it
so
is
that is why,
awareness.
Ratnesh, every small country that is trying to protect its small companies may not allow FDI in that segment. So India also, initially they were wanting to allow 100% FDI in retail sector, but then when there was so much of hue and cry from our small retailers, then we did not allow it. So every country has the right to make laws on which companies we will allow into our country, which sector we will open up, which sector we will not open up, which sector we will protect. All of that we can do. And Ratnesh, I'm sure you were not even born then, but till 1991, India was following a protectionist policy. That is, we were not allowing any foreign large players to come into our country. We were protecting our Indian companies because they were small, we had just become independent, and so on. After 1991, we have started opening up of our economy, and now you see all these big brands, big players in our market. They were not there pre 1991. Okay, so every country can have policies that they want to protect their industries and their small players. Okay, Ratnesh.
So, ma'am, like Google is an American company. So, in that case, before 1990s, if Google wants to come to India, Google couldn't come.
Yes, before 1991, we did not allow any foreign player to come into our country. We were only
Okay.
dealing with the foreign countries based on imports and exports. We were only importing some items and we were only exporting some items. There were no foreign players available in the country, registered as Google India or Microsoft India.
Okay, ma'am. Okay. Thank you, ma'am.
Okay, read about it. You will be very excited to see all of this, the changes that India has undergone over the last 20 30 years. It's been phenomenal.
Okay, ma'am. Thank you.
Okay, you're welcome.
Okay.
Anyone else? Any other doubts? Any other questions? Okay, so now what I will do is, now we will move to a case study which is focused around a startup, which is what will be the main focus for you. Okay, so for the purposes of exams and all, please focus on this only. Okay, so I'm going to share my screen. Samriddhi, is this visible? This is fine.
Yes, ma'am.
Okay, great. So as I told all of you, this case study and the startup questions that we will do will be what you will be focusing on for the purpose of this course, for the purpose of exams and all. Okay, so let us look at this. Suppose you are working on a venture that will produce and market a personal scanner accessory, also called PSA, directly attachable to a notebook computer. So suppose you are making like a handheld scanner. To date, the venture concept has progressed through the development stage with successful prototype, production, and test marketing. So what you have done so far, you have already developed the handheld scanner, you have made a prototype, and you have also seen test marketed it. The PSA quickly scans information on business cards with a standard 2-inch by 3.5-inch format to form customer lists of files. So basically you can use this to scan business cards and keep that information in a customer list or file. Generally you see people, struggling with hard copy of visiting cards and all, and they put it in albums and then they keep looking for it. So what if we could just digitize all of it? It can also be used to scan small photographs, charts, and other written information up to a 3-inch by 5-inch size. The scanner is hand-sized and designed for field use by sales personnel. The venture has an existing business plan, has been organized as PSA Corporation, which means a company, and now is preparing to manufacture and sell the PSA. So venture basically एक स्टार्टअप हो गया है, उसने अपनी कंपनी रजिस्टर करा ली है, and now they would start manufacturing and selling the PSA. Okay, now students, this word corporation is just the American equivalent for a company. In India we call it a company because we were governed by the UK, the British English, and in the US the same is called a corporation or a corporate. Business assets, usually referred to simply as assets, are the base on which a venture creates revenues and provides a return to investors. Assets can be tangible, physical items such as cash, property, and equipment, or they can be intangibles such as technological expertise, client list, patents, goodwill, all this. Accounting procedures track the acquisition, creation, use, and disposition of assets and dictate how one prepares financial statements. Okay, so all of this is now familiar to you. Now let us see the details of this startup. Table 4.1 shows what a balance sheet might look like for PSA Corporation on June 30th, even before the scanner production starts. So we'll come to that. The balance sheet presents a measure of the value of the venture's assets compared to a measure of the value of the venture's liabilities, plus any residual value belonging to the venture's owners, that is, external liabilities plus internal liabilities. The founder contributed $40,000 in cash to start the business. This is the founding equity capital contribution. A friend loaned PSA $10,000 for 3 years at an annual interest rate of 10%. So this is a loan that PSA has taken. The venture rents space in an industrial building for $1,000 a month to assemble and package their scanners. Recent equipment purchases, including a molding press to make the plastic case housing the scanner, the equipment needed to help assemble the electronic components, and other materials for manufacturing PSAs, total $20,000. PSA has $10,000 of material in inventory, but owing to the founder's excellent credit record and personal guarantee, suppliers have extended trade credit for the entire inventory, resulting in $10,000 of payable. So basically what has happened is, because a founder is very well known in the industry and the suppliers know that he is trying to start off on his own, they have given him all $10,000 worth of material on credit. Okay, so if we have this information for a startup, how do we make the first balance sheet of the startup? So this is what it would look like. The initial balance sheet, which is made on 30th of June, a day before the company actually starts production for PSA. Now look at the liabilities and equity side. Now since this is a US company, the way they show they marshal their accounts is, first they show all the current liabilities and then they show all the long-term liabilities. And in terms of assets, first they show all the current assets and then they show all the long-term assets. In India, we do the opposite. In India, we first show long-term assets, then we show current assets. And if we first show long-term liabilities, then we show current liabilities. Okay. So look at their current liabilities. Their payables in terms of creditors is $10,000. We have already seen the creditor has given them all the material on credit. We don't have any accrued wages or salaries payable. We don't have any bank loans, and we don't have any other current liabilities. So total current liabilities are 10,000. In terms of long-term debt, we have 10,000. That is a loan that the friend has given. We don't have any lease agreements with anyone, so that is 0. So we have total long-term liability of 10,000. Then we have the owner's equity, which is a founder's equity, the opening capital, which is $40,000. So our total liabilities and equity is 40 plus 10 plus 10. That is $60,000. In the asset side, the owner has basically, in the $40,000 that was there, 30,000 is still in cash and marketable securities. We don't have any receivables, so that is 0. We have inventory of $10,000, which the owner has bought on credit. So total current assets are $40,000. In this, we have gross equipment that we have purchased of $20,000, less accumulated depreciation of 0. Why is depreciation 0? Because according to the Income Tax Act, you cannot charge depreciation on a machine that has not been put into production. Only when the machine is actually put into production and the machine undergoes any wear and tear can you charge depreciation. So there is no depreciation charge right now. So the net equipment value remains 20,000. We don't have any building. We don't have any other long-term asset. So their total assets also are 40 plus 20, that is 60,000. And the balance sheet tallies. See how simple this balance sheet is compared to the detailed balance sheet that we have done in the MSL 302 material for a large company. Any doubts, any questions so far? If you have any doubt in any of the items, please ask. Okay. I can't see if anyone has raised their hand. So in case you have a question, please unmute yourself and ask. Now let us look at some more data and then we will look at this P&L. Okay. Now, on 1st of July, this was on 30th of June. On 1st of July, PSA hired an employee to operate the molding press and to help others assemble the business card scanners. With wages and benefits, that is payroll taxes, health insurance, etc., employee costs were substantial but were not a formal liability on 1st of July. However, now that the workers are employed, wage obligations exist. The founder has concentrated on marketing and distributing the scanners and has been drawing a salary and benefit at a rate of $36,000 per year. तो ओनर ने बोला कि भाई हम सब काम कर रहे हैं और मेरी salary will be $36,000 per year. A balance sheet for a given date balances the repositories of accounting value inside a firm, that is assets, with those promised to outsiders like liabilities and belonging to the owners, which is your equity. An income statement, on the other hand, tracks changes in the value of the various repositories over a given period. एक period के लिए बनता है, with an emphasis on netting those changes to determine the change in the accounting value of ownership. Basically, we want to see how much is the money that we have made for the owners. In the absence of equity injections or withdrawals, the accounting value of ownership, that is book value of equity, will increase by the amount of net income. अगर हम net profit बनाएंगे तो हमारी owner की value बढ़ जाएगी. अगर हम net loss बनाएंगे तो हमारी owner की value कम हो जाएगी. Okay. So now in table 4.2, we will have a 6 months income statement for the first 6 months of the operations of PSA in its formal life. Okay, from 1st of July to 31st of December. To see how the income statement tracks changes in the value of assets and liabilities, consider a cash expense during the period. As cash was depleted to pay the expense, the decrease in the cash account asset was mirrored by an increase in expenses reported in the income statement for the period. If the same expenses were incurred but funded by trade credit, then the increase in the repository of value represented by payables would be similarly mirrored on the income statement by an increase in expenses for the period. Either way, an income statement expense mirrors the net change in the balance sheet repositories of value, लेस कैश और मोर लाइबिलिटी। या तो आप कैश देके एक्सपेंस मीट करेंगे या आप लाइबिलिटी क्रिएट करेंगे इफ यू हैव नॉट गिवन कैश। Other things being equal, higher expenses diminish net income and the accounting value of ownership will increase by less than it would have with lower expenses. A similar situation exists for cash and credit sales. Increase in the asset, that is cash or receivables, would be mirrored by revenue on the income statement and the addition of higher net income to the equity account. So this is how basically your income or P&L would get translated into the balance sheet. Now let us look at the data that is given to us for the income or the P&L account. Scanners are priced at $100 each. Net sales or revenues after return scanners were deducted were $120,000. That is 1,200 units of scanners were sold at 100 each. All PSA sales were made on credit, payable in 30 days to large computer retail chains in the United States, which in turn mark up the scanners to sell to the public for 149 each. Now you know for a startup, not many people will give them cash. Okay. So what they have done is they have sold it on credit. They have said, please take our scanners, please pay us after 1 month. And what these large chains have done is they have upped the price of 100. They had bought at 100 and they're selling at 149. In December, PSA sold 500 scanners for credit sales of $50,000. Standard procedures required that PSA record these credit sales as revenue, although it won't receive the cash payment until January. So you know that it is showing it as revenue, but then they have not got any cash. They are showing it as debtors. Basically, those customers to whom we have sold, we have sold, but they have not given us any money. In other words, revenue is recorded as having taken place in December, and the value in receivables is increased by the amount of the revenue at the time the sale was made. When the cash arrives in January, the receivable account will be decreased and the cash will be increased by the amount collected. This is accrual accounting at its heart. To complete the income statement, PSA must first deduct the cost of producing the scanners from the $120,000 in revenues. The cost of production or cost of goods sold is the cost of the materials and labor incurred to produce the scanners that were sold. Production and inventory schedules must be maintained separately from the balance sheet and income statement so that PSA can determine the cost of producing the scanners and properly record the amount of inventories at the end of December. So here we know that the total cost of production for 1,200 scanners was $78,000. The venture's gross earnings are calculated as net sales minus cost of production. So for PSA, gross earnings, also called gross profit, that we saw is $42,000. That is $120,000 of revenue minus $78,000 of cost. Marketing expenses, including shipping and sales calls, were $12,500 during the 6-month period. Admin expenses of $18,000 covered the founder's salary and benefits during the first 6 months of operation. Other expenses included building rent of $6,000, depreciation expense of $1,000 on the $20,000 of equipment. Okay, so the venture's operating income, also called earnings before interest and taxes (EBIT), reflects the venture's profit after all operating expenses, excluding financing costs, have been deducted from net sales. So PSA's EBIT was 4,500 for the 6-month period. Okay, so let us see how it looks. PSA's income statement for the 6-month period ending 31st December. Net sales have been for 120,000 minus cost of goods sold gives us the gross profit of 42,000. From this we deduct the marketing expenses of 12,500. We deduct the admin expenses of 18,000. We deduct the business building rental expense. We deduct the depreciation, okay, and we get our operating profit or EBIT of 4,500. From this, we have to deduct the 6 months interest As I told you, interest is also allowed as a tax deductible expenditure. Then we get earnings before taxes. From this, we deduct the taxes at 25% to get the net income from the 6 months operations for PSA at $3,000. Okay, so we were discussing this only, the interest payments. Okay, all of this we have done. Yeah, so after we have come to EBIT, next, financing charges in the form of interest payments must be deducted from EBIT. Recall that the interest rate on the $10,000 loan from the founder's friend was 10% or $1,000 per year. So naturally, if it is for 1,000 for 1 year, then for 6 months you will only pay 500. Okay. Thus, the interest expense is 500 for the use of $10,000 during the first 6 months of operations. After paying taxes at 25% average rate, PSA earned $3,000. The venture's earnings are also known as its net income or net profit, or EAT, earnings after taxes. In the absence of withdrawals, the net income is the increase in equity. So suppose there are no dividends paid, then this net income is added to the balance sheet. Okay. PSA, unlike most new ventures, made a profit in its first 6 months of a formal operation. This is very rare in a startup that you make money in the first 6 months. However, before PSA can spend this profit, it is important to remember that the financial statements were prepared using accrual accounting procedures that do not emphasize whether cash is available to spend. So please remember, even today, even though PSA is showing a profit, but it still has not recovered the cash. It has still sold on credit. Okay, this is what happens in a new company. Now we should also see how the production and inventory schedules are made for each startup so that they know how much they are producing, how much they are spending for each scanner. Okay, so let us look at this. To make each scanner, PSA must purchase $40 of electronic components. Plastic material cost $5. Connectors, screws and other materials cost an additional $5. It took an average of 1.5 worker hours to make the plastic cases and to assemble each scanner. At the rate of $10 per hour, direct labor was $15 per scanner because it took 1.5 people to do it. So here in table 4.3, you can actually see the monthly production, cost of goods sold and inventory schedules for the PSA company during the first 6 months of operation. So let us see how the cost has been assembled. Electronic component is $40 per scanner. Plastic material is 5. Connectors, screws are 5. Direct labor is 15. So total cost of producing one scanner is 65. If the total units have been 1200, then you just have to multiply this by the number of units to get the total cost spent on each of the components. Okay, this is how the total cost is given, and this is how the company makes its production and inventory schedule. Any doubts, any questions so far? I think it has become easier for all of you to understand the startup example after doing the larger balance sheet and P&L. Okay, I believe so. But if still you have any doubts, any questions, you can ask. Okay. Now, students, in the first group assignment that you will do, which you will submit maybe just after your minor, Samriddhi, their minor is from 19th, right?
Ma'am, I'll have to check.
Just check once because I
Yes,
think
ma'am,
after this,
is
क्या रहता है?
it is 19 to 23.
19 to 23rd ना, तो
Yes,
आज
23.
24 हो गई है. So I think we can, the groups are already there, right, Samriddhi?
Ma'am, they have not yet made the groups as per my knowledge.
Who's the, Abhinav is the CR, na?
Yes, ma'am.
Abhinav is not here. So Samriddhi, can you tell Abhinav to float this thing, and I want the groups maybe by next week,
Okay, ma'am, sure.
because I think we can now give the first assignment.
Okay, ma'am.
ठीक है, so just groups बनवा लो, 4 to 5 people in each group.
Okay, ma'am.
Okay.
Yes, ma'am.
Okay, Sandeep. Thanks. Okay. So see, this is how the production and inventory schedule will look like. In the month of July, the company had made 200 scanners, and the production cost for each of these was electronic parts was 40 per scanner. So for 200 it was 8,000. Plastic material was 5 per scanner. So for 200 it was 1,000. Again connectors was 1,000. Direct labor was 3,000. So the total cost of production for these 200 units was 13,000. In August, again they produced another 200. Total cost was 13,000 for this. In September, they produced 300 scanners. So for this, the total cost increased to 19,500 proportionately. In October, again, they produced 300. So the total cost was 19,500. In November, they again produced 300. December, they again produced 300. So the total production that was there was 1,600, and the total cost of production was $104,000. So this is cost of production schedule monthly. So as a team, students, you will have to work on your business idea and give me cost of production schedules for your company as well, okay, along with the production costs. Then the second part is called the cost of goods sold schedule. That is out of the production, how much did you sell each month? So in July, we did not sell anything. In August, we sold 100 scanners, and we know that the cost was 6,500 at the basis of 65 per scanner. In September, we again sold 100. In October, we sold 250. So the cost for this was 65 into 250, that is 16,250. In November and December, November we again sold 250, which was 16,250, and in December we sold 500, which was 32,500. Okay, so total we sold 1,200 scanners, and the total cost of production was 78,000. This is how we arrived at the numbers. Now we create the inventory schedule for each of the months. In July, we had no opening inventory. We produced 13,000 worth of scanners. So we had total inventory of 13,000, and this became, and we did not sell anything. So this became the closing inventory for July. The closing inventory for July became the opening inventory for August. In this, we again produced 13,000 worth of scanners. So our total inventory now became 13 opening plus 13 what we produced, that is 26,000. From this, we sold 6,500 worth, as you can see. That means our closing inventory for August was 19,500. This became the opening inventory for September. We again produced 19,500 worth. Our total inventory now became 39,000. From this, again we take off the amount that we have sold. We are left with a closing inventory of 32,500. Okay, this became the opening inventory for October. Again, we add whatever we have produced, we subtract whatever we have sold to come to the closing inventory for October. This becomes the opening inventory here for November, and so on for December. So finally, in December, the closing inventory for us is $26,000. Okay. So let me go through. Yes. Now 200 scanners were produced in both July and August. Beginning in September, the scanner production increased to 300 units per month, resulting in 1,600 scanners during the first 6 months of operation. The cost of goods sold schedule in the table shows that 1,200 scanners were actually sold during the last half of the calendar year. Sales went from zero in July to a peak of 500 units in December. The venture's decision to produce scanners at a monthly rate that exceeded sales until December was based on the expectation that sales would continue to grow in the future. Also, at a monthly production rate of 300 scanners, the current workforce was being fully employed. The result of productions exceeding sales was a finished goods inventory of 400 units at the end of December. Okay. The $78,000 COGS from the income statement in table 4.2 was determined by multiplying the 1200 units sold by the $65 cost to produce each scanner. The middle of table 4.3 presents monthly and aggregate cost of goods sold. The lower portion of table 4.3, the inventory schedule, provides the schedule of inventories. Because PSA first began producing scanners in July, there were no finished goods or scanners on hand at that time. However, the $10,000 purchase of materials in late June made possible the July production of 200 scanners. After several weeks of operating, PSA found that the materials could be ordered early in the same month in which they would be assembled into a scanner. Thus, at the beginning of each month, materials were ordered based on the expected scanner production for that month. It costs $50 in purchased materials, that is electronic components $40, plastic materials $5, and connectors, screws, etc. for $5 to produce one scanner, and therefore $10,000 in materials to produce 200 scanners. No materials were ordered in July. A $10,000 order for materials was placed at the beginning of August. In September, monthly purchases increased to $15,000 per month to reflect the 300 units per month production rate for September and thereafter. Owing to production in excess of sales levels, finished goods inventories at the end of each month increased to a peak of $39,000 or 600 units at a production cost of $65 per unit in November. Even after record sales in December, the year-end inventories were still 26,000, the amount recorded as the year-end inventories account balance. So as you can see, this is just a description in words of the schedules that we have already seen and you have understood. This is just the description of each of these schedules. Now suppose we have all of this information. With this additional detail, we can prepare the year-end PSA Corporation balance sheet, that is in December. We begin by working down the asset side of the balance sheet. The venture has maintained a $1,000 balance in its checking account, although the original marketable securities were spent several months ago. So original marketable securities of 30,000 have been spent and we have a remaining $1,000 balance. Credit sales of $50,000 in December are the year-end receivables. Next, 26,000 is the year-end inventory. Current assets grew from 40,000 at the end of June to 77,000 by the end of December. Turning to fixed assets, the 20,000 gross before depreciation amount of equipment remains unchanged from the June 30th balance because no additional equipment were purchased. A depreciation charge of $1,000 for one half of the year implies a net equipment balance of 19,000. Adding the 77,000 of current assets to the 19,000 of fixed assets produces a total assets of $96,000. This completes the year-end accounting of the venture's assets. So now we have calculated what the assets should look like. We next turn to the liabilities and equity side of the balance sheet. Year-end payables amount to 15,000 from the credit purchases in early December to produce, let me first give all the data, then we'll come to the balance sheet, to produce 300 scanners for January of the next year. The direct labor cost was 4,500 in December. Admin, wages and benefits were $3,000, that is 36,000 per year divided by 12. Of this, 7,500, 3,000 had been earned but not paid and therefore represent the year-end accrued wages balance. We will return to the curiously high balance of other current liabilities shortly. Long-term debt remained at 10,000, जो उनके friend ने loan दिया था. The original owner's equity account of 40,000 was increased by the profit of 3,000 earned during the first 6 months of operations. Thus, the owner's equity account is now 43,000 at year end. The sum of financial capital from payables, that is 15,000, accrued wages of 3,000, long-term debt of 10,000, and owner's equity of 43,000 amounts to 71,000. Because total assets were 96,000 and recorded financial capital was just 71,000, there was a shortfall of financial capital of 25,000. So naturally assets तो आपके 96,000 के हैं, लेकिन आपका recorded capital जो है that is only 71,000. So where is the remainder 25,000 coming from? That is, PSA did not have enough money from the founder's investment, the initial loan, and trade credit to sustain the first 6 months of operations. Somewhere, PSA borrowed more money to stay afloat, creating a short-term liability. This means somewhere PSA has borrowed money. Okay. This is typical problem for new ventures. Even when they are profitable, they may be out of cash and forced to go to extreme measures to fund profitable operations. As I told you, you can see the profit there, but you can see that the company is out of cash. Okay. PSA's founder applied for and personally guaranteed 2 credit cards. Together, they provided a line of credit of $30,000. Both had introductory rate specials of 0% for the first 6 months, rising to 12.9% thereafter. जैसे क्रेडिट कार्ड में होता है, पहले वो आपको फ्री में देते हैं, बोलते हैं आप यूज करिए and then suddenly the interest rate on the credit card jumps. So once PSA starts paying interest on the carried balances on these credit cards, the income statement will have to reflect the additional interest expenses. अभी तो फ्री में है, तो अभी कोई पैसा देना नहीं पड़ रहा उसको, ठीक है? So let us look at the balance sheet now. In terms of liabilities and equities, we have current liabilities of 15,000. We have accrued wages of 3,000. We don't have any bank loans. We have other current liabilities, that is 2 credit card debts of the owner, bringing us to a total current liability of 43,000. We have long-term loan of 10,000 and we have the owner's equity of 43,000, which gives us the total liability and equity of $96,000. On the asset side, we have cash and marketable security of 1,000. We have receivables of 50,000. We have inventory of 26,000, which gives a total current asset of $77,000. Then we have gross equipment of 20,000 less depreciation, which gives us a net equipment of 19,000. Again, we still don't have any building. We still don't have any other assets. So the total assets also are 96,000. Okay. So this is how the balance sheet would look like after 6 months of operation for this startup. Any doubts, any questions, please ask. Okay, I would like to close here because we just have 2 more minutes left and take any doubts, any questions that you may have. Samriddhi?
Yes, ma'am.
I can only see 5 students here. I am seriously very doubtful that the 80 people who have supposedly registered are even interested in doing this course. Or even if they are, if they think that just by doing these recordings, they would understand financial accounting, I really doubt that.
Yes, ma'am.
I don't know what we can do for these students. I don't know. Can you send out an email that it is strongly advised that all the people who have registered for the course that they should attend classes, even though we cannot have any marks for attendance or anything. But can you just send out an advisory email?
Yes, ma'am. Sure, I will.
Okay. So I would stop here and we will continue from this. And Samriddhi, also send out an email for the groups. I want the groups as quickly as possible so that we can give them the first assignment.
Okay, ma'am.
Maybe then,
Yes,
what?
ma'am. I've already intimated Abhinav about this, that he should float a Google sheet regarding this.
हाँ, क्योंकि अगर आई थिंक पहला असाइनमेंट दे देंगे ना, उसमें प्रेजेंटेशन करा लेंगे, तो मे बी द पार्टिसिपेशन विल फोर्सफुली इंक्रीज बिकॉज मार्क्स एसोसिएटेड रहेंगे ना.
Yes, ma'am.
सो लेट्स डू दैट क्विकली फिर, ठीक है?
Okay.
Okay everyone, so please read and we'll carry on from here in the next class. Okay, So all the best. Thank you so much. And thank you, Samriddhi. And thank you, Aniket, Nitesh, Pritesh, Ratnesh, and Ronit for being
Yes,
here.
ma'am. Thank you, ma'am. Thank
Yeah,
you.
Thank you,
thank
ma'am.
you so much. Thank you. Take care. Happy learning. Bye bye. Bye. Thank you.